Hello, hello, hello. How's everyone doing? How's everyone's weekend? Hello, hello, hello. Test, test, test. Can everyone see me? Can everyone hear me? Let me know. How's everyone doing? Hello. Hello, SVY. Hello, Gert. I hope I pronounced that correctly. Hello, hello. Hello, Maria. Hello, Robert. Hello. Hello, Eddie. Thank you, likewise. From Germany. Love to see it. Okay. Okay. Hello, Tone. Hello, Astro. Hello, Alan. Perfect. Hello, hello. Let's take a look at the market, shall we? Let's see what we're dealing with. First of all, before we dive into the markets, from Switzerland. All right, nice. I'm doing good. Thank you very much. Before we dive into the market, let me pull it up. Let's see what we have. Important to understand. Let me see. There it is. If you have any questions throughout this live session right here, then feel free to ask me. You can go towards this link right here in the bottom left. Link is also in the description here, right there. Link is also in the description. You can ask me anything. Again, we're going to go over the most popular questions. If you want your question to be answered, ask a good question, properly formulated, and we might go over it. You can give questions also a thumbs up right there to make sure that the questions you ask have a better chance to get answered as well. So feel free to ask me anything. We're also going to dive into the forecast. First of all, feel free to ask me anything, what you struggled with in this past week. Did you struggle with anything? How was this past week as well for you? What are you looking forward to next week? Any struggles or any concerns heading into next week? Feel free to ask me. Feel free to ask me. All right. Let me see. Your autumn high video made my last week so profitable. A demo, love to see it. And we move on from demo to live. That's the goal. Hello, Thanos. Okay. Hello, JB. Hello, Rafi. Thank you very much, AD. Thank you very much. All is good. Okay, without further ado, just dive into it. Thank you, Elias. Thank you very much. Thank you. All right. I need a haircut. Yeah, you're right. You're right. You're completely right. Okay, let's see. Let's dive into it. Let us dive into the market. Okay, perfect. Let's just start off with the dollar. Again, I had hoped by now we had the volatility video online, which is not the case. But again, it will be online very, very soon. So you can watch out for that as well. We'll talk about the economic calendar and some things that have changed regarding that as well. Anyway, without further ado, let's first dive into just the technical analysis right here, what we see. Okay, perfect. Starting off with the dollar. Afterwards, we'll dive into the indices as well, which we can potentially start seeing some new all-time highs, which could be very interesting heading into next week. At this moment on the dollar, what are we looking at? Okay, we are looking at potentially short-term bullish market right here. So what I think is very interesting to understand, if we remove everything that we have right here, is that we have this daily fair value gap right there. That daily fair value gap will play quite a crucial role. Why? Because that daily fair value gap right there, if we do want to continue higher right here, we can potentially trade back into it to then continue higher from it right there. If we do want to continue lower, and let's say we see a huge drop off like that, then it's likely that the fair value gap will play a huge role as well, because we will likely create a rejection low within it right there to then potentially start running the rejection low to then continue lower. So is that going to happen? I have no idea. What we're going to prepare for right here, and what is very important to understand for your forecast as well, when you are going to do your own forecast, is you need to outline the different options, the different possibilities of what can potentially happen right here. So that's exactly what I'm also going to do. Right here, if we do want to continue lower, then it's likely we are going to create a rejection low and we're going to see some price action like this right there to continue lower. If that happens, okay, we can potentially look to get involved after we start running the rejection low right there. We'll shortly look what that looks like then on the majors, for example. If that doesn't happen, and the other option is, okay, we trace back into it right there and we already continue higher like this. When that's the case, start targeting these highs right here. These highs, these higher highs right there as well. Both scenarios, in my opinion, quite interesting right there. So the dollar right here looks quite interesting heading into next week. Now, the way that reflects on, for example, an Australian dollar US dollar, fair value gap right there as well, which we can potentially continue lower from right there. Now, of course, is it guaranteed that we are going to retrace back into the fair value gap to then continue lower from it? No. So what is another option that we have? We also have the option that we might already take out the thing that is preventing us from continuing lower. For example, this 4-hour fair value gap right there. So what would that look like? Let's say we open up the week, we don't get a retracement back into the daily fair value gap. Instead, we see something like this. We trade back into the 4-hour fair value gap and we start running this rejection low right here to already continue lower like this. To not get left behind waiting endlessly for potentially the daily fair value gap to get traded back into, which might never happen. What we can do is we can also have this parameter right here. So we're preparing. We're again preparing for all the different options of what can potentially happen right here. I hope that makes sense on Australian dollar, US dollar. Now, that is essentially a very similar thought process on also an EU, on also a GU, on also a New Zealand dollar, US dollar, for example. What is important? When you have all these different majors that are potentially quite interesting because the dollar is moving in a certain direction, then are you going to trade all of them? No, you're going to pick the right one. So for example, if we take a look at Australian dollar, US dollar, compare it to a Euro US dollar, I would argue Australian dollar, US dollar at this moment in time is weaker than Euro US dollar. So that would mean that Australian dollar, US dollar has an easier path to potentially continue lower. Which of course, if you want to look at shorts right there, and if you want to look at lower prices, then it is ideal that we have an easier path to continue lower, like Australian dollar, US dollar. Where in Euro US dollar, yes, we can continue lower, sure, but it might struggle a little bit more to continue lower. Same for example, a GBP US dollar right there, because it's a little bit stronger right there. So a New Zealand dollar, US dollar, Australian dollar, US dollar, those two to me are the most interesting right there to continue lower at this moment in time. US dollar, Canadian dollar to continue higher is quite all right. We also have a fair value area right there, overlapping fair value gap. Can potentially continue higher from that as well. That looks quite nice, in all honesty. Looks quite good right here to continue higher. All right, let's see. US dollar CHF, US dollar JPY, to me, not necessarily that interesting. I would rather stick to, for example, US dollar, Canadian dollar, Australian dollar, US dollar, or even a New Zealand dollar, US dollar right there as well. Why is it weaker? Good question. So why is it weaker? If we take a look at this price action right here, if we put them side by side, Australian dollar, US dollar, and for example, Euro US dollar. Okay. Here we have Euro US dollar, and here we have Australian dollar, US dollar. Why is it weaker? Right here. A couple of things. So what do fair value gaps tell us? Fair value gaps tell us when we are moving into a certain direction, right? So if we have a bullish fair value gap, it's likely that we're going to continue in that direction because we're quite strong as well. When we have bearish fair value gaps, it's likely that we're moving in that bearish direction because that means we're moving lower, so we're quite weak at that moment in time. So for example, if you compare Euro US dollar to an Australian dollar US dollar, now already simply using the eye test, the fair value gaps right here are larger on Australian dollar US dollar in comparison to a Euro US dollar. But on top of that, we also see more fair value gaps on Australian dollar US dollar. We have one right here, we have another one right there, and we have another one right there. Here we have this tiny fair value gap. We have, well, you could actually argue we have the same amount of fair value gap. Sorry about that. Is this a tiny fair value gap right here? Maybe. Okay. Now the fair value gaps are larger right there. On top of that, if we take a look at Euro US dollar a little bit before, when we see this price action right here, and we see this new expansion to continue lower, if we are truly very weak, what should have happened, which we did do on, for example, an Australian dollar US dollar right there, we should ideally create a new fair value gap right here already to potentially continue lower from it. Not create such a deep retracement back into that tiny fair value gap to then continue lower from it. So overall, it's been moving lower more aggressively. Now, what does that tell us? that tells us that, for example, an Australian dollar is weaker than a euro at this moment in time, relatively seen to the US dollar. So that means that the US dollar is, well, a lot stronger than Australian dollar. And euro is a little bit more even than the US dollar. So that means Australian dollar right there has an easier path to overall continue lower, simply by looking at the fair value gaps, the size of the fair value gaps that we have right there, the amount of the fair value gaps that we have as well right there. If we compare it, for example, to a New Zealand dollar, US dollar, you'll see it very evidently right here. We're moving lower a lot more aggressively, if that makes sense. Good question. All right, if we move on to the metals right here, before we dive into the indices again, where we can potentially see all-time highs. The metals right here, gold and silver, in my opinion, quite interesting to continue higher at this moment in time. Now, gold, we talked about this on Friday. And on Friday, it was quite late, not only during the day, also during the week, that we can potentially continue higher. I'm not a big fan of that. I would like to see what we can do when we open up right here again, and then see if we can potentially reach a new all-time high. If we take a look at this fair value gap right there, it's just, again, all-time high protocol. So we create this fair value gap against us right here at this moment in time. If that turns into a 4-hour fair value gap eventually, perfect. We take the 4-hour fair value gap. If this turns into a fair value gap right here, we take this fair value gap right there. The most important part is, can we overtake these fair value gaps right here to then clear up the path to continue higher towards an all-time high again? That's the only thing I'm going to be looking at on gold. So there is also going to be an option right here on gold that we might want to continue lower by disrespecting this fair value gap to then continue lower right there. I'm not going to look at it. I'm not interested in that. And the reason why is because the momentum is so bullish. So if the momentum is so bullish right here, I don't want to look at those shorts. Those shorts are, generally speaking, for my trading plan, already lower probability. So that's not really worth the risk, if that makes sense. So silver right here, very similar in that regard, simply looking to buy at this moment in time. Now we've hit a couple of targets on silver as well. Can we zoom in to the daily time frame to potentially find a new target? Could argue this one. Let me put a line right there. Okay, let's see what we have. All right. On the 4-hour time frame, we have this fair value gap right there to potentially continue higher from as well. Okay, very similar actually. We have a 1-hour fair value gap right there that I would like to see overtaken to then continue higher again. So what would that look like? Well, you can go back into this previous week or this week that we were in, and we can see the same thing. So we have this 1-hour fair value gap right there against us. If we can overtake it right there, took a rejection high, and run it, continue higher. Same with this fair value gap right there. If we can run the rejection high, continue higher again. If we can run the rejection high of this fair value gap right there, continue higher again. And that's then also the area, for example, right here, this area right here, this area right here as well. Those are what we call areas of opportunities. That's where you're going to start looking for your entry, for example, at least in my trading plan. So that is exactly what I'll be waiting for on silver and gold. Okay, if we move on to the indices right here. Now, there's one thing that is important to understand regarding the economic calendar in this upcoming week. And that is, we have NFP on Friday. We have NFP on Friday. And what that means, NFP on Friday, is that potentially late Thursday, early Friday, before we have the NFP release, that could be a little bit tricky. So why? Because what tends to happen is that you might create, or we might create consolidations before we actually see all the volatility coming in at Friday. That's important to understand because, of course, trading consolidations is not ideal. So if you do notice that on a Thursday, ahead of NFP release, we start creating these consolidations, then you simply want to take a step back, wait for the NFP release, and then potentially trade afterwards as well. Very important to understand. So how do you recognize? How do you recognize if we do create a consolidation? Well, at its core, what is a consolidation? A consolidation at its core is fair value gaps towards both sides of the markets not following through. So if we go into the lower time frame, for example, right here, we see that we have these bearish fair value gaps. These bearish fair value gaps are not following through. What is following through? Following through is this. When we see this fair value gap right here, we trade back into it and we create a new bearish fair value gap. That means it's following through. That means the fair value gap is holding. So we see right here a bearish fair value gap being created. we trade back into it, we don't follow through. We don't create a new fair value gap to continue lower. So then we have a bullish fair value gap right there. Okay, the bullish fair value gap in the short term right here creates this new bullish fair value gap, a tiny fair value gap right there, where you could argue we might follow through a little bit. Afterwards, we create these new bearish fair value gaps right there again, where this one doesn't follow through. These bearish fair value gaps don't follow through either. The bullish fair value gaps here also don't follow through with a new fair value gap. That is typical signs of consolidations when both sides of the markets are not following through. So what does that lead to? We're not moving anywhere. We're just doing this right here. And when this happens, it's very hard to profit from it. Well, hard, relatively speaking. So right here, when we take a look at this, when we're clearly moving from point A to point B, not consolidating, it's easier right there. That's not a consolidation. That's very important to understand. So when you notice that ahead of NFP, take a step back, be careful. Now right here on ES, what have we been doing on the higher time frame? We've been very bullish. There hasn't been, that's quite insane actually when I think about it. There hasn't been, since the 1st of May, 2025, this year, there hasn't been a single bearish monthly candle and people are still trying to look to short. Explain that to me. That doesn't make any sense. I do good during consolidations, perfect. Some people have a trading plan for consolidations, that's perfectly fine. Don't try to short in a market where we have just been going higher. That doesn't make any sense, right? Okay, I hope I don't need to explain that or rant about it anymore. So right here, if we take a look at the weekly, we see we've also been moving higher. Now, right here, we do have this weekly fair value gap. Could we retrace back into that to then potentially continue higher? What have we just said? That we're very bullish. We've been moving higher very aggressively. Don't force the retracements. If the retracement happens, perfect, but don't force it. So how can we know if we are going to retrace or, well, no. What are the probabilities? What is more likely to happen? How can we get a good feeling of what is more likely to happen? That we are going to retrace back into the weekly fair value gap or already continue higher, like a new candle like this. Okay, how do we know that? Well, simply said, if there is nothing preventing us from continuing higher, then we are already likely to move higher. So for example, here we have this fair value gap. Since we have that fair value gap, we can potentially continue lower from it right there. Because there's something that is preventing us from continuing higher, right? So when we see right here, this fair value gap, and more specifically also this fair value area, if these are disrespected right here, which is order flow resistance, which we do by running the 2 candle rejection high right there, which we talked about in Friday as well. If we start running the rejection high right here, then we are disrespecting the fair value area, fair value gap. So they are then non-existent essentially. That means that we don't have any order flow that is preventing us at that moment in time from going higher. So it's very likely that we are first going to then reach for the next all-time high right there instead of creating a retracement back into the weekly fair value gap to then potentially continue higher, if that makes sense. So what is important? To know if we are going to run this rejection high right there. So what are we going to open up on Monday right there and going to see a new expansion candle right here above this high? If that's the case, can we see 2 candle rejection failing right there? Can we then start to continue higher right here towards the all-time high? So for example, if the moment we start running it, which is why I put the box here, not at the exact highs, because it might take some time before we actually start running it. That is where we can now look for an entry right there towards the all-time high as well. Again, and that's just all-time high protocol over and over and over. So right here on NASDAQ, I'm going to do the exact same thing. Can we start running this rejection high right there? And can we then potentially reach towards an all-time high? And first of all, we don't even need an all-time high right here for this to be interesting. Because even if we just reach for the next PDA, and we reach for this next PDA right there, and we reach afterwards for this next PDA, and these are all areas of opportunities right there where it can be interesting to look for an entry as well. That's very important to understand. So very similar to gold right here on the indices, I can spot opportunities for the bearish side. 100%. There were some opportunities on the bearish side right there as well last week, but some of them didn't play out. Some of them arguably did. I'm not going to look at the bearish opportunities. I'm not going to look at shorts on NASDAQ and ES. And simply why? Because we have been moving higher so aggressively. Now, does that mean that we will keep continuing higher? No, but that simply means that the probabilities are in your favor to keep moving higher. So the probabilities are a lot lower if you now start taking a look at shorts. That's very important to understand. So right here, all I want to do is simply look for a reason to buy and buy and buy again. And what is a reason to buy? A reason to buy is when there's nothing preventing us from continuing lower anymore. Because then you have all the reason to buy. Because then we have all the reason to move higher. That's important to understand. So when that happens and we start running the rejection high right there, that's very interesting to continue higher again. Looking forward to that. Again, don't get your hopes up. You have the parameter right there. If the parameter does not get met, you don't do anything. You just sit on the sidelines, right? So don't force an ID right there. Oh, we need to continue higher. I need to look for an entry right now. No, just wait. Wait. Just simply wait. All right. Russell right here, that's essentially the same thought process. We're not necessarily dealing with an all-time high on Russell because we still have some higher highs right there towards the left as well. But it's the same thought process. Same thought process right here on Russell as well. Same thought process on, for example, a YM as well, which actually has been quite strong right here when I take a look at it. But we do have a daily fair value gap that we are dealing with, which we didn't have on ES and NASDAQ. All right, so we can start running this rejection high. Same thought process right there as well. Same thought process. DAX to me, not that interesting. And the reason why is because it's been consolidating a lot right there. So I'm not really that interested in DAX, to be honest. I'm mainly going to pay attention to, for example, YM and NASDAQ and an ES right there as well. All right. Bitcoin. A little bit in between. So for example, we have this weekly fair value gap that we talked about that we are still respecting. If we do want to continue higher, we should run this rejection high right there to then continue higher. We could potentially see it fill a little bit earlier if we start to disrespect this fair value gap right there. But as of this moment right here, it seems like we're just moving lower. So we have just been moving lower. We have been respecting fair value gaps quite nicely right there. So in all honesty, it wouldn't surprise me if this is the next target right there, that low right there. Now, either then that means that we can potentially continue lower from this fair value gap, like we see right there, or we might run this rejection high right there to disrespect it to potentially continue higher instead, if that makes sense. Two parameters right there. Crude oil, to me, not that interesting right here. I'm not a big fan of this. This doesn't look that interesting. There's enough out here that could potentially be interesting regarding the majors, regarding the indices as well. So that's the same for the crosses right here. The crosses is just not super interesting in my opinion. If the majors, if the indices right there, if the metals are potentially interesting right there as well. All right, if you have any questions after this, during this, before this, right here. If you have any, 22 thumbs up, people are active. That's very nice to see. If you have any questions right here, go to link in the description as well. You can also join at slido.com and then it will ask you for a room number. Just the room number right there. And then you can join. You can ask any question that you want right here. The most popular questions get answered right there. So try to formulate your question properly. Try to come up with a good question if you have one. And then we can dive into that right there as well. All right. How was the forecast? Does it make sense? Does it not make sense? Let me know in the chat at this moment in time. What in the world is Russell? It's RTY right there. It's Russell, E-mini Russell right there. Russell 2000. Let's see. Does it make sense? Let me know in the chat right here if it makes sense. If it doesn't, of course, feel free to let me know as well. Let's see. Makes sense. Perfect. Thank you, SVY. Thank you. Thank you very much. Perfect. With the Forex forecast, I'm afraid you did, but of course, this is a live session, so you can just go back. You can just go back. All right. Perfect. Okay. Thank you very much. Let's dive into the questions then. Let's dive into it right here. Let's see what we have. Could be, to be honest, could be. It's quite suspicious, Mr. Bob, right here, that our friend Eco right here has the exact same likes right there amongst all his questions. That's quite interesting. That's quite suspicious. That's quite suspicious. All right, we're going to go over, to give everyone a fair chance, we're going to go over one of Eco's questions right here, which is the top one. Afterwards, we're just going to dive into the next questions as well. I'm sorry, but It does seem a bit suspicious right there. Okay. Giving everyone a fair chance to ask questions. Let me see. How do I stack up arguments? Switch buys. Should we use only current action on each time frame? Also, can we use order flow lags as arguments on monthly and weekly? Yes, for sure. For sure. You can stack up arguments, switch buys right there. So let me dive into that. Okay. What are arguments? Arguments is, well, what I think is very important to understand. Arguments is essentially respecting and disrespecting PD arrays. That's what it comes down to. So for example, when we respect certain discount arrays, that is an argument. When we even create fair value gaps, that is also an argument. It's essentially the concept that we use, the concepts that we use that create arguments. So order flow lags in itself are also arguments, if that makes sense. So how do you use these arguments? Well, you stack them up. So you stack them essentially. We have, for example, in the MMT, it's just to show it more clearly. We have an indicator right there because it's quite objective right here. Where at the moment we start, and again, the indicator is not 100% correct. I don't recommend indicators are either there to help you with your learning curve, or they don't help at all. They should not take away the trading. That's very important to understand, because I see some people promoting indicators like it's going to help you become profitable. It's not the case. It's not the case. It can either help your learning curve or it's just complete BS. So right here, when we talk about an indicator as well, like this creates all the arguments. So for example, we see bullish fair value gaps created with a bearish fair value gap to kind of objection, disrespected right there, etc., etc. It stacks up the arguments. And when you stack up these arguments right here, you get to a certain probability in price. Now, of course, 100% right there is something always going to be 100%. Let me actually move my face cam. No, nothing is always going to be 100% guaranteed. Very important to understand. But right here, we see that we have a lot of bullish arguments. We just have one bearish argument, which is still this fair value gap, which is still the fair value area that we have at this moment in time, for example. So if we disrespect those, then there's no more bearish arguments. So we have simply a clear path to continue higher because there's only bullish arguments left, if that makes sense. Now, how do you switch bias? You switch bias also through these arguments. What is very important to understand is that switching your bias takes time. You don't switch your bias bullish, bearish, bullish, bearish, bullish, bearish. If you have been bullish for a long time right here, we have been continuing higher, we have been bullish for a long time. Then the moment we start creating retracements right here, this is not the moment where you immediately turn bearish right there. So you switch your bias. No, you more so go from bullish 50-50 to then either we continue bearish or we continue bullish. So it's always, switching bias is always bullish 50-50 to either bearish or bullish again, or bearish to 50-50 to either bearish again or now bullish, if that makes sense. And the way you go about that is again arguments. So for example, right here, if we were bullish, the moment that we create these retracements, we turn to 50-50 right there. Now, if let's say these fair value areas actually followed through lower right there, and we start disrespecting this bullish fair value gap right there, the weekly fair value gap, then we could argue, okay, well, we switched from bullish 50-50 to now bearish right there. And the reason why is because then you protect yourself a lot more. You're not trying to call tops and bottoms in the markets right there. That's very important to understand. Let me know if that makes sense. Right there. All right. Explain an unusual context entry with an example. For sure. Unusual context is simply a fair value area failing and we continue lower, essentially. So for example, this right here, if this fair value area fails right there and we continue higher, that's unusual context, if that makes sense. So this, for example, right here is also unusual context right here. We have a fair value area right there, a rejection high from the fair value area right there, also the fair value gap, perfectly fine. And then this right here is where we start running the rejection high. If we go into the lower time frame, and that is where unusual context happens. So for example, fair value gap right there to continue higher from it right there. If that's fair value gap entry for you, perfect. Targeting a 1 to 2 hour right there. And essentially what unusual context is, it's fair value area failing. When a fair value area failing, it's not offering fair value anymore. So we're seeking liquidity at the top of the fair value area right there, if that makes sense. And that's essentially it. Essentially what it comes down to. I hope that makes sense. And this is very fractal. So for example, if we take a look at this scenario right here, fair value area failing right there. If we go into the lower time frame right here, into let's say the 1 minute time frame, we can see it more clearly. It's not that nice. But right here, we see, for example, rejection lows, fair value gaps right there. And we continue lower towards the fair value area low right there, if that makes sense. So the way that works is the fair value area, we offer fair value. And if we offer fair value, we can already continue lower, continue higher right there in the same direction. If we don't offer fair value, which is seen by the rejection low failing right there, the first move higher failing right there, and we create these new fair value gaps to continue lower. When that happens, we're seeking liquidity at the bottom of the fair value area. That's unusual context, if that makes sense. It's a good question. Let's see. Gold. Okay. Gold recently came off a daily fair value gap. There was a 4-hour fair value gap in the way. Once we run the rejection high of the 4-hour fair value gap. I'm talking too fast. Once we run the rejection high of the 4-hour fair value gap for you, what would have been the way to enter? Okay, good question. Let's see. Let me see which example you meant right here on the daily time frame. Do you mean the most recent one, or do you mean the previous one we had right here last week, or this week right here? So let's dive into it. Okay, let's go over both right here. So in both examples right here, if we take a look at this 4-hour fair value gap first, it's very similar to the current scenario that we have. So we can go over both. We see that we have this rejection high. So if we start running this rejection high, we're disrespecting the fair value gap. We have a clear path to now continue higher. Okay, where's the entry then going to be? Okay, right here we have the 4-hour rejection high. The first candle is not a rejection. Okay, but what does that mean? If the first candle is not a rejection, then the second candle should sweep the previous candle high to then create a rejection. If that doesn't happen, then what are we doing? If we are running the rejection high right there, we are already disrespecting the 2-candle rejection right there. So for example, right here, to continue higher, you could dive into the 1-hour time frame. To now look, or even the 15-minute time frame, to find these fair value gaps, because the reason I want to find fair value gaps like this here, for example, an order flow lag, is because when you enter on this order flow lag right there, you can cover the order flow lag low, if that makes sense. And it's a safe place for your stop loss to then continue higher again, targeting a 1 to 2 hour. Now, if I assume right here, you didn't mean this entry. And if we go over this one right here. So here we're coming from a daily fair value gap right here. And the reason why I like this question quite a lot is because this daily fair value gap is what we can potentially continue higher from. But it's very important to understand. I need you to understand right here that a daily fair value gap, yes, we can continue higher from that. But as long as we have things that are preventing us from continuing higher, we're going to struggle to continue higher. And that's very important to understand. So right here, why do we create these consolidations? Why do we not instantly continue higher right there? Yes, the daily fair value gap is stronger. So in theory, it should do something like this, which is exactly what it did. Just took some time to happen right there. Now, the fair value area failing right there is very important. It's not necessarily about the fair value gap alone right there, because the fair value area should be failing. And then you'll see this ties into the question that we had previously with the unusual context. Why? Because unusual context happens once the fair value area fills. Once the fair value area fills, the last line of defense, which is this swing high, becomes the target. So do you notice something? That if the fair value area fills, the order flow lag fills. And then this high becomes the target right there. So what is important to understand right here, it's not necessarily about the fair value gap right here. Because the fair value area fills, yes, but the fair value area could still push price lower to then ultimately continue lower. So this is also the overlapping defense. If the overlapping defense fails, the last line of defense becomes the target. That's important to understand regarding your order flow. So this right here is a rejection high. Okay, same thing. This candle, could you argue it's a rejection high? Could you not? It doesn't really matter. What we see right here is that we start running this candle right there, running the rejection high right there. So if we go into the lower time frame right here, and I really want to go into the 15-minute time frame as well, you'll see it more clearly. This is the pattern I love so much. And this exact same pattern is the same pattern you'll see with the previous rejection high that we talked about, which is this high. From the 4-hour fair value gap, right? That we talked about. Let me see. This 4-hour fair value gap, rejection high. On the 1 hour, it's the same exact pattern. Create a rejection, expansion candle above it again. If we go into the 50-minute right here, from this fair value area towards the left, create a rejection, create new expansion phase candles up again. So how do you enter on this? The way I enter on this is I use expansion candles. So the moment we create these expansion candles right here, when we start running the rejection high, that's where you want to look for an entry. So right here, where does your stop loss go? Below this low right there, below all these lows right there? No. It goes below the most recent order flow lag and below the recent fair value gap that we have, or that's in creation, and fair value area. So this right here turns into a fair value area, right, in the future, because this is also going to turn into a fair value gap right there. So in the worst case, we could stagnate here, we could struggle here, we trade back into it to then continue higher. And again, if you think, Arjo, you're talking a lot right now, and I need to see this in real time, perfect. Because I passed FTMO challenges here on YouTube showing you it. I got a payout here on YouTube showing you it with this exact same system over and over and over and over again, if that makes sense. So if you are in that scenario and you're like, well, I need to see this in live action, watch those videos. Watch those videos. It's the same thing over and over and over again, if that makes sense. So that's very important to understand right there. This is, that's essentially my trading plan, if that makes sense. Let me know if that answers your question. If it doesn't, of course, feel free to let me know as well. Hello, Sitesh. Could you give an example of a top-down analysis for entry? I often do the right analysis, but end up hitting my stop loss due to incorrect placement. Thank you. Very, very good question as well. Okay. What is important when we talk about top-down analysis for your entry? What I think is important to understand is there's something that comes before your entry. So when you notice right here, when I talk about these different scenarios, do you notice something? I'm always working with an area. I call the area of opportunity. It's also a context area. I'm always working with an area. There's one thing that I discovered. Well, I discovered, that sounds very weird. I'm not some kind of scientist. I'm just a regular guy. I'm not trying to make it seem like I discovered something special. Absolutely not. But there's one thing that you can notice. Let me put it like that. When you start paying attention to price action, where do these fair value gaps hold? And in the past, I was also asking myself, where do these order blocks hold? Where do these fair value gaps hold? Why do they hold in such a specific area? For example, right here. Why do they not hold in this area right here? Why can't I take an entry right there? Why would it hit my stop loss right there before continuing higher? And this is important because when you talk about top-down analysis, we start off, and there's a simple list for this. Well, simple. We start off with bias. The next, we start off with narrative, or you can also replace this with context right there. Then we have our entry right there that is going to be within the context area. And then we have our risk management right there. Now, what is important right here is the bias is usually not that hard to figure out, right? I think everyone can have quite a good idea of what price action eventually wants to do. Gold, we eventually want to continue higher. It doesn't take a genius to figure that out, right? It's not rocket science. The same for EU, for example, or Australian dollar, US dollar. Okay, I think we might want to continue lower first. Again, it's not the hard part. Now, what is a little bit more difficult is finding your specific context area. And the context area, why it's so important to understand, is because a context area is where your entries in the short term are going to hold. A context area is where price moves in between PDRAs. That's it. So where price moves in between PDRAs, that is where fair value gaps, where order blocks, etc. hold. So right here, if we take a look, what does it mean to trade in between PDRAs? If we disrespect this PDRA right here, which is the fair value area, by running the rejection high, then that means price is for a short term free to move towards the next PDRA, that swing high. Why? Think of it like this. When we go lower right here, oftentimes you'll notice we go lower because of this fair value gap. If we don't continue lower from this fair value gap, we continue lower from the next swing high or next fair value gap, whatever it may be. If we don't continue lower from that, we might continue lower from something higher above that right there. Then it might be something like this to then continue lower from it. Okay, if we understand that, then what about these moments? The moment we disrespect one PDRA to move towards the next PDRA, that's where price is free to move. Because in between right here, there's nothing that can push price lower right there. Not on the same time frame. So that is then your context area right there. And your context area is very important to understand for your entry. So when you start taking a look at entries, oftentimes I think entries are not really the problem. For example, 15-minute fair value gap right there, or 15-minute expansion candle right there works out very nice until we reach that next target right there. But why does this one not work right here? Because this one is not within that new context area. And that's very important to understand. So this question, in my opinion, I want you to check for yourself as well. It comes down a lot to your context area. Where are you taking the entries? That's very important because usually that is going to help you with your actual entries, if that makes sense. If that makes sense. Good question. Good question. Very, very good question. Very good question so far, by the way. I love it. Thank you very much. Thank you very much. I like this question as well, ASR. We're going to dive into it. What's your advice on what to do after passing a funded challenge? Well, let's first dive into that. Sorry, Billy. Sorry, we're also going to dive into your question, Billy, afterwards. What is your advice on what to do after passing a funded challenge? Don't get too excited. I have a video on this, actually. So if you go to my channel, because I record the process of passing a funded challenge, getting that payout, getting the first payout, etc. What it's very important to understand is, let me first start from the absolute start. It's important not to gamble. So not gamble your way to one large payout. Listen, if you are going to make a payout of $10,000 tomorrow, you might tell me, Arjo, wow, that is incredible. That is a lot of money, and it is a lot of money. But if that one payout is spread out over 2 years, it's $10,000 in 2 years. Now, for most of us, that's not incredible. Then it becomes $5,000 per year. What is that? Around $400 per month spread out. That's not incredible for most of us. So right here, what is important to understand is that you want to build a healthy relationship, for example. So you don't want to hit a casino, one-time jackpot, big payout, and then get banned by a prop firm. No, you just slowly want to first pass the funded challenge. When you pass the funded challenge, what you do is you keep low risk. The first thing you do is, if you can, if the prop firm allows you, you get a refund. You get a refund of the challenge fee. So the way you do that is by making some profit, just a little bit of profit. So you get your investment back. So then at least you have your investment back. Now you're risk-free. You're risk-free, essentially. And what you can then do is slowly start getting payouts. And then after you get these payouts, you want to have another account. And then the ball starts rolling, if that makes sense. That's essentially what you want to do, ASR. But don't take that after passing a funded challenge. Get first your money back. That's very important to understand. And then afterwards, you can potentially up the risk a little bit. But first, just get the money back. Get the money back. Very important. Let me know if that makes sense, ASR. If it doesn't, of course, again, feel free to ask. How in the world did you go from professional basketball player to trading? That's a massive switch. It is a massive switch. The way I started off, so I did a study computer science. Then in my second year of doing the study computer science, I don't remember anything regarding computer science, by the way, so don't ask me any questions regarding that. But well, I learned a lot of live things, but not necessarily computer science in itself. But then what I did is at around 17 years old, I got an offer in Italy to play professional basketball in San Benedetto de Tronto, for the Italians. They might know it. Then COVID hit. So COVID hit and I couldn't play basketball anymore. So I was at home. And then eventually I met a teammate, and that teammate had, we call it in the Netherlands, is bol.com. And it's essentially the Amazon of the Netherlands. And he had a store there. So I was like, okay, that's quite interesting. Maybe I also want to start my own store. So I used to sell these what is it? I used to sell these jaw things that would improve your jaw. Anyway, it doesn't really matter. And I made some profit from that. And what I did with that, I started investing in stocks. So I was very early into Palantir, for example. And what happened is I made some money from stocks. And I was like, okay, well, seems to be more profitable than what I'm doing, whatever, with the store that I have right now. Can I turn this into a full-time thing? And then afterwards, what happened is I started to get into day trading more. I started to get into Forex, for example. I started to get into all these different things. But my first love in trading was actually stocks. This is also why I like stocks so much. That's where it started. That's where it started. If that makes sense. Ik ben Nederlands. Ja, I'm Dutch. Yes. So that's where it started. So seems like a massive switch, yes, but it was slowly, like there were all these things that happened in between, if that makes sense. Okay, Billy, yeah, I see. Billy, I'm sorry, Billy, for keeping you waiting. Let's see. How to get involved in a run on liquidity where we don't have the entry of an ST or ST plus RE? I like this question as well. Great question, Billy. So when we think about this, right, it's very interesting because when you want to see, when you take a bullish entry and you want to see price move higher in a bullish entry, then what do you not want to see? A retracement, right? So this is very funny when you think about it, because I never entered on fair value gaps. Even when I trade delirium, etc., I never really enter on fair value gaps. I enter on the creation of fair value gaps, yes, but I don't really enter in a fair value gap. So for example, I don't enter when we retrace back into a fair value gap. So when you want to see this price action move higher right here, this is the perfect price action, right? Where we just have a straight line to the take profit right there. So how do we go about that? Well, first of all, I need you to understand, in scenarios like this, I actually prefer not to see a retracement, but a lot of people, they enter somewhat counter logical because they want price to move higher, but they do want to enter on a retracement. How does that make sense? Because you actually don't want to see a retracement at that moment in time, right? So what is important right here? Use expansion candles. What are expansion candles? Instead of waiting for the fair value gap to be created right here, to then retrace back into it, to then enter right there, you're already too late. You missed the boat right here. You missed the party. You wait again. So what do you wait for instead? Well, right here, the fair value gap gets created. Second candle right there. Second candle of a fair value gap. An expansion phase candle is the following. An expansion phase candle is the second candle always of a fair value gap. So for example, right here, we have this candle, which could be a future fair value gap. So that means this right here, the body, is an expansion candle. The same way, this next candle right here, this could also be a future fair value gap. This is another expansion candle, a large one right there. When we start to create these candles, that's where you enter, if that makes sense. And then covering, you think ahead, what should happen right here? Well, in the worst case scenario, if we do consolidate here, we have a fair value area, we have a fair value gap that we could retrace back into to then continue higher from it right there, right? So that is a future order leg right there. So if this becomes your entry right here, covering the fair value gap, etc., then targeting a 1 to 2R, that is how you capitalize on that, if that makes sense. It's a good question. Hope it makes sense, Billy. Sorry to keep you waiting. Can we take a trade when there's no resistance at all? Because I thought the resistance was the narrative. Can we take a resistance when there's no trade, when there's no resistance at all? Because I thought the resistance was the narrative. Perfect. Perfect. Absolutely perfect. Yeah. But then it's a little bit different in those scenarios right there. So for example, you can then, in those cases, you can also wait for example, a fair value gap to then continue higher from it, etc. as well. But yeah, that's perfect. That's perfect. When there's no resistance at all, that's all right. That's all right. For sure. Hello, Daniel. Can you check gold on Thursday? We had a clear all-time high protocol reacting on the daily fair value gap and running the 4-hour rejection high of the opposing 4-hour fair value gap. Okay, let's see. On Thursday, I think I know which scenario you mean. We talked about it a little bit here, I believe. It's this one right there, that one right there. Okay, so I didn't mention this in the all-time high protocol video. I'm sorry. I did mention it to the MMT members. Now, I'm sorry, YouTube students. But what I think is important to understand is in the all-time high protocol, the reason why I didn't go over it is because when I need to explain fair value area as well, we go quite in depth, if that makes sense. And it goes very in depth to then get very confusing very fast, if that makes sense. So for example, for the people that know it, this is a fair value area, right? So what makes an order flow lag? An order flow lag is the following. An order flow lag is when we have a swing high followed by a fair value gap. When that's the case, usually, not always, we tend to also have a fair value area right here, which is essentially the retracement before we continue lower right there. It's a little bit more in depth than that as well. But what we see right here is that we then have 3 PD rays essentially in an order flow lag. We have the fair value gap. The fair value gap is the first one that we trace back into right there. It's also known as the first line of defense. We also have the fair value area, which is again the retracement. That is the overlapping defense. Then we have this swing high, the swing high of the order flow lag, which is the last line of defense. It's the last thing that we could potentially retrace back into to then continue lower from it. So what is important to understand right here is that if we want to continue higher and perform an all-time high protocol, we need to understand, when does an order flag actually fail? It fails when the overlapping defense fails. When the overlapping defense fails, the last line of defense becomes the target, if that makes sense. So right here, the overlapping defense fails, and that's the fair value area, once we start running this rejection high. So for example, if you only had this fair value gap right here on your chart, there's nothing inherently wrong with that, but you do need to understand the first that we can run is then the fair value area, because we can still create a rejection from that, if that makes sense. So only once we start then disrespecting the fair value area, that's where we have this clear path to now continue higher, if that makes sense. So that's quite important to understand. Now, in some cases and some scenarios, you do not create, or we do not create these fair value areas. For example, right here. Here, if we already continue higher, we do not really have a fair value area. We still respect the swing high, the rejection high that we have right there. In scenarios like this right here, what we talked about, here we do have the fair value area right there. So that is very important, the fair value area right there. The same thing on gold right there. It's the fair value area that we have at that moment in time. Let's see if we can find maybe another example of that as well. Well, here, for example, here the fair value gap is more important right there. That's the overlapping defense at that moment in time. We'll start running that to then continue higher towards a new all-time high. If that makes sense. It's a good question. It's a good question. Let me know if that makes sense, Daniel. See, did I miss anything? And run the rejection high to the opposing 4-hour value gap. Okay. All right. Hello, Anonymous. Okay, let's see. If we are using no resistance area style trading, does time news matter? Yes and no. The video is coming. I'm sorry for saying that the video will be long today. I'm sorry about that. But the video about that time and news is coming as well. Because things have changed. It's quite funny because I still see people posting economic calendars like it really matters. But economic calendars matter, yes, but not in the usual sense like it used to. So for example, big 3 news events are very important. Yes, for sure. But did you know that according to the data that I have here, which I'm going to make a video, and the video is already recorded, it's going to be online either tomorrow, as soon as possible. The data right here, this is data from Biden and also Trump data, tells that Monday has been the most volatile day regarding of the news events. And people are still sitting here claiming, oh, Monday you need to watch out because we don't have news. Do your research. And that's very important to understand. So that's what we're going to dive into as well. But in general, does it really matter? Start off with a naked trading plan. So the way I see that, whenever you create a trading plan, you start off with a naked trading plan. Sounds a bit odd, but what I mean by that is a naked trading plan, essentially you don't have all these rules. So it's just a very straightforward trading plan. For example, no resistance area. Okay, that's where I trade. Don't add news until you see for your specific data that you see, hey, this actually matters. So for example, if you start trading and you have a sample size of, let's say 10 to 20 trades with that no resistance style, and you took a couple of losses and you're maybe, let's say, break even at this moment in time. And then you go over trades and you see, okay, well, on these days right here, there was news that actually mattered. And because of that, I lost, or I needed to take it into account. And if I did take it into account, I had more winners, etc., etc. If that happens, then you take it into account. But at the start off with naked trading plan, if that makes sense. Start off with that. Let's see, Mr. Bob. How are you? Saw the hoop in the background. How's basketball? It's going well. The hoop is actually right there. Can you see it? It's hanging right there. It's hanging right there. It's going well. I must say, a mini hoop like that is very tough. It's very difficult, actually. Let's see. Okay. Much rejection high. Hit opposing PDA or form from nothing. Gold. Why did you mark out that higher rejection high, not a lower rejection high nearby? Ideally, it is from an opposing PDA. Yes. So if it does form from nothing, you can still mark it out. But if it forms from nothing, for example, right here, then I want to mark out, well, if it forms even from this opposing PDA right there. So it's sort of a dominance effect. We call it dominance effect in MMT. So the way that works is, for example, if this one fails right here, this fair value gap, then in theory, that's a dominance effect right there, that this swing high is also getting ran because nothing is preventing us from continuing higher anymore right there, right? If that makes sense. So you can already potentially get involved a little bit earlier right there to continue higher, if that makes sense, instead of waiting for the full rejection high to get run. If we have enough space, So for example, here on gold with this fair value area, there's enough space from this rejection high towards the next target. When it's the case, I just take this one, original one, rejection high right there, if that makes sense. And I don't go into the lower time frame right here to then find the fair value failing right there, if that makes sense. And if that was your question as well, if that was your question, Mr. Bob, thank you very much. Basir is spamming. Oh. Let me see. No worries. I usually notice it quite well when people are spamming, etc., etc. So if you spam, Basir, your chances of getting your question answered, they decrease a lot. So don't spam, because I'm basically not going to answer your question. In a nutshell, I'm very petty when it comes to that. Just answer a good question. If it's a popular question, if it's a good question, it will get answered, if that makes sense. But spamming it won't help anything. Yeah, he's spamming a lot. Let me see. Okay. All right. Okay, perfect. Let's see, let's move on. Okay, let's see. How do you avoid being taken out by spread while you swing trades? Spread and swing trading, usually they go quite hand in hand. So what I mean by that is you shouldn't worry about it too much. When you swing trade and spread, it's not too bad. If you go into the lower time frame, really the 5-minute time frame, etc., that's where you really need to worry about it, if that makes sense. But other than that, it's all right. It's all right. For example, the entries I take right here, spread doesn't really affect me, if that makes sense. So that's all right. Now, what is important to understand is that for your spread, so where it gets added, again, spread gets added to buy orders, right? And we're talking specifically about CFDs, Forex at this moment in time, not futures. But when we talk about spread right here, it gets added to buy orders. So in a buy order, what is the buy order? The entry. So that's where you need to take into account spread right there. So for example, if you buy right here, whilst price is already moving higher aggressively right there, you do have a chance if, and for example, I also have this, if I enter an expansion phase candle, which is exactly that, then I might click buy right here, but I get filled a little bit higher right there. If that's on the higher time frame, it's a minimal difference. So for example, swing trading, 4 hour, 1 hour, maybe 50 minutes, doesn't really change it, if that makes sense. It doesn't really affect the trade a whole lot. If you look at sells right here, again, the buy orders is the stop loss and the take profit right there. So again, in swing trading, that doesn't really have an effect. If you dive into the crosses, for example, the 5 minute on the 1 minute, yeah, that gets dangerous. Then that gets very dangerous. But swing trading, generally speaking, you should be all right, if that makes sense. All right, time for some water. Let's see. Exactly, Auntie. Exactly. Ugh. Arjo mentioned before that he does not show the materialistic things that can be achieved from trading because he wants to provide us with process mindset rather than thing mindset. Very nice, Auntie. I was thinking about this actually today because I saw some people and because I feel like the goal nowadays is always a nice car. It's always this. It's always a nice watch. It's always is money, etc. And again, inherently, there's nothing. I'm not against money or anything or like that, right? I think that's very important to understand. A lot of my job right here is money, so that wouldn't make any sense. But I feel like a lot of people's goals are not determined by themselves. So I think social media nowadays has such an influence on the goals that people set for themselves, where social media determines the type of goals that you are going to have. For example, if I open YouTube and I'm a beginning trader, most of the time it's going to be cars. Most of the time it's going to be nice watches, whatever it might be, that are thrown at you, etc. And they tell you, this is the thing that you want. You should want this thing. You should want this car, if that makes sense. And again, there's nothing wrong with wanting a car, but I think you should ask yourself, is that really the thing you want? Is that really the thing you want? And if that's really the thing you want, go for it. Go for it. And then still, you should see, is trading the method of achieving that thing that you want as well? Because the way I see it is, money in itself inherently is not necessarily the goal. For example, if I think about, I want to make money from trading, then do I really get obsessed with, I want to make money from trading, or do I get obsessed about the process? Because if I get obsessed about the process, that process will achieve me that goal, if that makes sense. It's always a byproduct, if that makes sense. It's not the goal in itself. The same way, if I want to make a lot of money through a business, for example, then what is the goal? Is it making a lot of money, or is it making a really good business? Because that really good business will bring you a lot of money, if that makes sense. So then it's a byproduct of the goal. And I think that's very important to understand for yourself, to ask yourself as well, what is the thing I really want? What do I really want in life? And if that's a nice car, go for it. Go for it. But I think that's very important. I think people are led to, it's do as I do. It's they are led to believe they want a certain thing that they do not actually want. And usually that's also social media, I think, plays a huge part. So it's very important for yourself to ask as well. I always wanted to go to Dubai because of these influencers, but when I analyze myself, I'm more the type of person who wants nature and peace. And the idea of Dubai was only because of social media. Yeah, I've personally never really been a big fan of Dubai. Nothing wrong with it, but I don't know. It's just not my cup of tea. Not my cup of tea. All right. Anyway, let's move on right here. Let's see what we're dealing with. Let's see what we are dealing with. Hello, FEG Amateur. On gold last Friday, we have a 4-hour rejection high towards the left, and it's a previous day high. According to the high time rule, which time frame to see token rejection here? Do you see 1 hour or below to analyze the dollar? To analyze the dollar? Oh, okay. Question 2 right there. Okay, 2 questions in one. That's sneaky. Let's see. On gold last Friday, we have a 4-hour rejection high to the left. Last Friday. Do you mean this past Friday, or do you mean this Friday right here? That one. For me, by the way, so it might be because I'm looking at futures. So I look at the COMEX chart right here. I look at futures when it comes to gold. But I don't have the daily Verweigap against us, if that's what you meant right there. Let's see. The previous day high. Ah, no. Never mind. A 4-hour rejection high. Okay. Never mind. Okay. So on the 4-hour rejection high right there, that is also a previous day high. The previous day high doesn't really concern me, if that makes sense. It's more so about the 4-hour rejection high in itself. Now, when we talk about the 4-hour rejection high right here, you stick to the 4-hour time frame. You can also go down the time frame. Now, what is important? For example, when I go down time frames right here, I'm quite good at what I do right here. I have quite a good understanding of what I want to look at. For example, on the 1 hour right here, I can already see from the 4-hour rejection high that it is failing right there. But I need you to understand that, for example, if you go into the lower time frame and you go too low in time frames for your experience, if that makes sense. And on the 1 minute time frame, you might argue right here, oh, it's already failing, so I can get involved in this 1 minute Verweigap. But you need to take into account the 5 minute has not created a rejection yet. The 50 minute has not created a rejection yet. The 1 hour has not created a rejection yet. When the 1 hour fails right here, the 4 hour has not created a rejection yet. And it might not, but it might also at the same time, it might, if that makes sense. So right here on the 4 hour, we need to understand that this is the full token rejection, the same time frame. So when you go down a time frame, the moral of the story that I'm trying to explain properly is that it can still happen that the one time frame below shows you that it's failing, but a little bit later, the time frame above, the same time frame as the PDWA, then actually creates a larger rejection, if that makes sense. So that's quite important to understand. So here, if we take a look at the same time frame, this is the first candle right there. Second candle, then according to token rejection, could sweep the previous candle high to then create a rejection. Doesn't happen. We start running it. So that's when we can already continue higher. And then I'm not too worried about the previous day high, if that makes sense. Did you use 1 hour or below to analyze the dollar? Not really. Not really this past week. I was mainly sticking to the daily and the 4 hour time frame. Those were quite important in my opinion. But the 1 hour, I sometimes use it. Don't get me wrong. But in the past week, not really. No. I've really been sticking to the 4 hour and the daily as well. Right there. But in some cases, I do use the 1 hour right there. In some cases, yes. Let's see. At what point did you decide to trade full time? What was the tipping point in your journey? Currently in a part-time toxic job. Thanks for your advice. Well, my scenario right there, I was in quite a luxury position as well. So what I think is very important to understand, you need to always have a backup, always. And even if you start trading full time, it's quite nice when you have something to the side of it. So a lot of times, I don't think the goal should be to completely full-time trade. And you can do it. You can absolutely do it. But when you do, make sure that you at least have a backup. So for example, you have, and this is not financial advice, by the way, this is just talking about my scenario. At least you have some monetary backups as well. You can fall back quite easily on certain things as well. That's very important to understand. But the tipping point is usually going to take longer than you expect. So what I think is very important is that a lot of people, and I see this quite often, people try to jump from their job, immediately quit and go full-time trading. The pressure that comes with that, if you don't have a backup, the pressure that comes with that, if you don't really have any, if you haven't seen any profitability or anything like that, is just immense and it's likely not going to work. So 9 out of 10 times what I see in those people as well is that they go back to their job sooner or later, after a year or whatever it is. So I think it's very important to understand trading full-time, what that actually inherently means is that you might be looking at the chart 2 hours a day. So oftentimes trading full-time is not full-time as in you're going to be sitting there from 9 to 5 to actually take a look at the chart. So you can very, very well, as a retail trader, you can combine it quite well with next to something as well. The most time that you're going to spend trading is usually the learning, the studying, etc. But other than that, actual trading in itself is just waiting a lot. So oftentimes, even trading full-time when you're waiting a lot is not good, because then you're just going to force certain things because you are waiting and you feel like you should be doing something, if that makes sense. It's quite important to understand. That's quite important. So for you, in this case, for me, not financial advice, I would say see if you can stick to that part-time. If it's toxic, see if you can potentially fix that at the job itself as well, or maybe potentially find something else. But really have a backup right there. That's very important to understand. Don't dive into it full-time just yet, if that makes sense. That would be my advice. Keep me updated on that, Johnny. Let's see. Which candle should I use as a guide during a run? For example, the first rejection high candle or the previous candle? What do you mean by that? Which candle should I use as a guide during a run? For example, the first rejection high candle or the previous candle? The first rejection high candle or the previous candle? I'm not sure what you mean with the previous candle, because what would be the previous candle? Would that be before the rejection high? Maybe I'm overthinking it. But the way I see it is which candle you use is essentially two-candle rejection. So for example, right here. Here we see this high right there. The first candle is this rejection. So that is the candle that we use as a rejection high right there. So if we want to see a run, then we use this one right there, if that makes sense. This one, that rejection high. Now, sometimes there will be a scenario. Let's see if we have an example. Let's take this one, that swing high, where it takes a while before we create this larger rejection. When it's this case, then we use this rejection high, if that makes sense. If that was your question, I hope I understood that correctly. Hello, Inte. I hope I pronounced correctly. Hello. Can you please show an example of an ST plus RE with their respective time frame alignments? For sure. Let's see if we have an example. Let's take this fair value gap, 4 hour fair value gap. If it's 4 hour fair value gap, we dive into the 5-minute time frame unless there's a need for more confirmation. So where do we create the ST plus RE? Right here. We have one here before. The ST right there already fills, actually. We don't create a RE, so we never have the ST plus RE. It's only afterwards. But if the first one fills, I usually want more confirmation afterwards as well. So let's see if we can find another better example right here. Let's see. Maybe just for the example's sake, we can take a look at ES or NASDAQ from this fair value gap right there. It's 4 hours. So again, would be the same, would be 5 minutes. If it's the daily, I would go to the 15 minutes. If we take a look right here. Okay, where does the ST happen? Fair value gap happens in right there as well. Fair value gap happens out right there. Actually quite early already. So here we have the fair value gap. And then all I'm looking at right here is just, do we have fair value gaps holding? So do we have an order flow lag right here and a new fair value gap that's holding from that, if that makes sense? So for example, then this could turn into the RE right there. And then this, for example, if you're trading an ST plus RE, that would be the entry. And then you're covering the most recent order flow lag that we have right there, targeting a 1 to 2 R. That would be it, if that makes sense. Let's see, what is the average win rate for the what is preventing us from going higher method at 1 to 2 R, and how does it compare to what are we rejecting from method? Very good question, Sky. I would like to break this down properly. Very good. Okay. The average win rate depends a little bit. I had across 3 months or 4 months, so the phase 2, the payout stage, etc., with FTMO, etc., where I really tested it, etc., I had a 100% win rate. Is that realistic? Absolutely not. So what I did in September is I started pushing it a lot more. I started just taking every single trade. And what you'll then notice is just essentially taking every single trade that looked a little bit good was around more so 50, 40% win rate right there. But that can be increased very easily to, for example, because from the data that I have from, let's say, to 60, 70% win rate right there, if that makes sense. Let's see. And how does it compare to what are we rejecting from? Yeah, I like that question a lot. So, for example, right here, if we take a look at the dollar, I like this example. We have this daily fair value gap right here. At the same moment in time, we also have this 4-hour fair value gap right here. So how does it compare? Win rate wise, it compares, well, you can make both work in that scenario. For example, during my delirium days, I also had a win rate of around 80, 70%. So you can make both of them work. In general, for the potential that I see, the what is preventing us from continuing higher, for example, method has a higher win rate potential than what are we rejecting from in that sense. But the way I see that is, for example, if you start taking a look at this daily fair value gap right there, what are we rejecting from? We could potentially continue higher from that, right? Here, the same way, we have this 4-hour value gap. What are we rejecting from? We could potentially continue lower from that. So in scenarios right here, and this happens oftentimes when we retrace back into a fair value gap to then potentially continue higher, usually what happens is when we retrace back into these fair value gaps to then potentially continue higher, there's something that is preventing us from continuing higher. So at first, you'll notice these consolidations. And only once we start to overtake the thing that is preventing us from continuing higher, then we start to actually create these runs, these fast runs, these aggressive runs. So right here, what you'll notice is first we have these consolidations right here. It's not necessarily about what are we going to continue higher from. It's more so, is this 4-hour value gap still preventing us from continuing higher? And the way I see that then is then you're somewhat always one step ahead, if that makes sense. Because you're one step ahead because you're not in this consolidation. So for example, I'm going to draw a couple of examples. Actually, we have quite good examples right here as well. Let's see. Yeah, this is perfect right here. Okay. There's a couple of things that can happen with a fair value gap. Like this. We have the first example right here. We retrace back into it right there to then just, well, fail essentially. Here we have a fair value gap that we retrace back into it and we continue higher. Okay. Here we have a fair value gap that we retrace back into and we consolidate before we start to continue higher. So there's 3 different options. Here you might take a loss before you take a winner. Here, well, like we saw in lower time frame, you might also take a loss, but let's assume you take a winner right there before we continue higher. Here you might take another loss right there. There's 2 losses. That's maybe 1 winner, maybe 2 winners right there. Now, what do all these 3 have in common? That all these 3, these right here, these first 2 would have been winners if you understand what is preventing us from continuing higher, because that's where the clear run happens. The same right here, what is preventing us from continuing higher. That's where the clear run happens. The same right here, what is preventing us from continuing higher was always respected, so you never take the loss right there. So it's somewhat, you're one step ahead, as in you're not taking the same losses and you're taking the winners in any scenario, if that makes sense. Good question. Yeah, I had a 100% win rate in US 30 for a year, but the algorithm changed. Okay. Okay. Let's see. Good question, Sky. Good question. I kind of lose more when I drop to the lower time frame and later to find that if I had entered on the higher time frame, it would have been a win. For day trader, is it better to enter on the higher time frame or the lower time frame? When you ask me this question and you say right here that you drop to the lower time frame and later to find that if I had entered on the higher time frame, it would have been a win, start using the higher time frame. And again, if you start using the higher time, that doesn't necessarily mean that you're going to be a position trader or a swing trader or anything like that. You can still use the higher time frame and be a day trader. Because if you trade one singular 4-hour candle, for example, that you enter on, still arguably a day trade, right? That makes sense. So I wouldn't worry too much about that. Wouldn't worry too much about it. So in this case, let's stick to the high time frame for sure. For sure. Why not? Why not? If the data shows that, and again, data goes above everything, right? Data goes above everything that I mentioned as well. Thank you. Okay. Let's see. I assume which cause sometimes price does disrespect float and odd, and it can't reach the swing high. This happens. So what I think is very important to understand, when I create these general rules, right? Because I've also mentioned it during the live stream right here already, that if the float and the overlapping defense fails, then the last line of defense becomes the target. There's probabilities supporting that, if that makes sense. Does that mean that it will work out 100% of the time? Absolutely not. Absolutely not. And again, it's not meant to be 100% time thing. So the reason why I laughed a little bit at Basir comments right there, and I clicked it away, is because Basir mentioned I had a 100% win rate in US 30 for the past year, and now the algorithm changed. We're not dealing with an algorithm. We're not dealing with an algorithm. It's quite funny. And and there's also, again, you could have definitely had a 100% win rate, but if you only took one trade, achieving a 100% win rate is quite easy. So there's a lot of context going into that. I'm not trying to make fun of Basir here, but I'm just trying to show an example that is very unrealistic. And even if you have the mindset of I need a 100% win rate, usually that's completely wrong. You don't need a 100% win rate. You, for 1 to 2 hour, if you have a 34% win rate, you're going to be profitable. And not by a lot, but you're going to be profitable. So for the long term, you're going to be profitable if you have a 34% win rate. But usually people, they need a 100% win rate to be able to cope with the fact that they can't take losses, if that makes sense. So what I think is very important to understand, nothing I mention here is going to work 100% of the time. So sometimes overlapping defense fails, like you mentioned, and it just does something like this. So it doesn't reach the last line of defense. There's something like this right there. And if that happens, it's just probabilities playing out. Just probabilities. That's what it is, if that makes sense. So what I also think is very important, I'm going on a little bit of a rant, but I think it's very key to understand for you as a trader, is that if you do consistently start looking for these 100% things that need to happen 100% of the time. So I think a good example is our industry. Because people start looking for these 100% things, and what they do is they come up with more things to be able to get closer to that 100%. So for example, how do you think a lot of concepts that you see online on YouTube, social media, Twitter, whatever it may be, get created? It's because someone sat there and thought, I'm losing. I don't have the 100% win rate. Okay, so every time I lose, there's something that happened that I missed. And you need to accept, sometimes if you take a loss, it could be a good loss. It's just probabilities. Just probabilities. So don't get too caught up in it. But if you do get caught up in it and you think, there should be something, you start adding these tiny concepts over and over. That's how you get a Reaper fair value gap. That's how you get a unicorn, whatever it might be. All these different things that don't add on to the previous concepts. So what I think is very important to understand is that usually that's a psychology issue. It's not a concept issue, if that makes sense. And then the coping mechanism becomes, but there's an algorithm, and the algorithm is never random. So if it's never random, there should be a 100% win rate, because I should know every single time what is going to happen, because there's an algorithm. There's no algorithm. Let it go, my friends. Calm down. That makes sense. So that was not necessarily entirely your question, but that's what it comes down to, if that makes sense, MMT. A lot as well. Let's say we have a bullish 4-hour value gap, and on the 1 hour, we have created and respected a bullish fair value gap. Okay. Okay. Is the 4-hour value gap no longer advisable to trade off of? Why? If we have a bullish 4-hour value gap, and on the 1 hour, we have created and respected a bullish fair value gap as well. Do you mean from the same fair value gap or different fair value gap? If it's from a different fair value gap, yes, then it becomes a little bit tricky, because it might be a breakaway gap, that 4-hour fair value gap. If it's the same fair value gap, you do want to trade from it, if that makes sense. If that makes sense. Ugh. All right. Who's Ruben? Let's see. Last couple of questions, team. We have 150 questions, 149 questions. That's quite insane. Thank you for all the questions. Half of that is Basir spamming the question, but that's all right. It's still nice. Then we have 75 questions in total. Let's see. Okay, let's see. Please kindly clarify regarding two candle rejection. Is the second candle close above the first candle? Does it invalidate the two candle rejection, or is the two candle rejection validated by the second candle? If the second candle closes above the first candle, then yes, because two candle rejection is failing, so it somewhat invalidates it. Yep. Correct. Okay, let's see. Yeah, good question, by the way. I had an engineer. I want to go over this one as well. Last week, Wednesday, right there, didn't we disrespect it? Oh, let me see. Let me see. I believe you mean this example right here, right? Yes, perfect. No, we didn't. So why didn't we? So what have I mentioned quite often is that how do we disrespect a swing high? We need to, no, let me start over. Okay. In order to disrespect this fair value gap, what needs to happen? We create a rejection high right there. In order for us to disrespect this fair value gap, we need to run this rejection high, right? What is running a rejection high? Running a rejection high is disrespecting a high. So what is disrespecting a high, or what is disrespecting any PDA? It's the same process. So right here, if we want to run this high, we need to disrespect it. Disrespecting happen through two candle rejection. Now that means, for example, I've mentioned this during the MMT as well. That means if you took a trade like this, I don't mind it. I think this overall is good trade right there. But if you notice, you take these trades too often, and oftentimes it still does something like this. You need to understand, we have not disrespected this swing high yet. We've not disrespected the rejection high yet. Because on the same candle time frame right here, on the 4-hour time frame, which, again, that's the important time frame, we see first candle is not a rejection, second candle goes sweet, previous candle high to then continue lower, according to the rules that we have, right? So this is a very good example, actually, of right here on the 1 hour, it seems like we're already disrespecting the high right there, but on the 4-hour, the rejection happens a little bit later on. And that's why it's important, if that makes sense. So it's a very good question. Very good question. Again, I need you to understand as well, if you took this trade right here, I don't mind this at all. At all. I think this is overall a good trade right there. But if it happens often in your data as well, you might want to wait a little bit longer until we fully disrespect it, same time frame. Let's see. Is the dollar correlation in gold a real thing? For example, does a bearish dollar argument such as dollar running a rejection low automatically means bullish on gold? Good question. Yes, there is correlation, 100%. Yes. They're inversely correlated. So that means if the dollar is moving higher, gold should move lower. As you can see, that's not always true. The correlation is not as strong. So the correlation between, for example, a gold and the dollar is not as strong as the dollar and Australian dollar US dollar, because it's directly correlated, if that makes sense. Same for the indices right here. So ES and the dollar right there, yes, In theory, they are also inversely correlated. In practice, so in real time, it's not always going to be the case. So if you trade gold, if you trade ES, for example, I wouldn't worry too much about what the dollar is doing. It's going to confuse you more, in my opinion, than add any value, if that makes sense. If you trade Forex, yes, it is very important because it's very close to fully 100% correlated, if that makes sense. All right, team. Ooh, what a session. I think that's it for now. That's it for now, team. Team, we are going to be back. Again, we go live Friday, every Friday and Sunday, 2 p.m. New York local time. So next week, we are also back here, Friday and Sunday as well. All right. Thank you, everyone. We have videos coming up as well. A lot of videos coming up. So I'm very excited for that as well. Live streams again, Friday and Sunday. And you can always ask questions as well. We'll go over them, etc., etc. So if you have questions that you want to ask next week, feel free to ask me. Okay. Thank you, everyone. Thank you, everyone. Can you comment on the algo change? The algo didn't change. There was no algo to begin with. You've just been tricked into believing there was. Thank you, everyone. Take care. Take care. I'll see everyone on next Friday as well, and with the next video as well. Talk about volatility, etc., etc. And yeah, that's it. Thank you. Take care, everyone. Have a great rest of your weekend. Thank you, thank you, thank you, thank you. Thank you. Remember what we talked about as well to start the forecast. I think it's very important. You can rewatch these live streams as well. You can rewatch them on my channel. So they will be there. Thank you, everyone. Thank you, Marcus. Thank you, Sami. Thank you, Mousy. Okay. Thank you, SUI. Thank you, thank you, thank you. Tomorrow's my birthday. Happy birthday, Temple. Happy birthday. Have a nice day. Have a nice day. All right, all right. Okay, thank you, everyone.